Hello folks and welcome to this video lecture. Today we look at Module 2. One of my favorites is Evaluating Financial Performance, Financial Analysis, Critical Thinking, Financial Research. And financial statements are the primary tool for communicating the health of a business or an organization. And to analytics like myself who are also investors, financial statements provide key, very important investment information. So here we learn about the basic financial statements, some different approaches for analyzing them. An important aspect underlying all of this is cash flow. You're going to hear me use that term ad nauseum, because cash flow is the backbone of all value. The price of a stock is a function of its cash flow. The price of a bond is a function of its cash flow. The valuation of a business is based on its earnings or some earnings multiple. The price of real estate, residential real estate or real estate investment trust, is a function of cash flows. So using cash flows, we learn how to calculate and evaluate financial statement ratios. Financial ratios are merely expressions of relationships found between items on the balance sheet and items on the income statement, and we'll take a closer look. I believe that as part of your CSU-Global education, that we should all have a basic understanding of financial statements and what information they convey, because financial statements, your financial statements or my financial statements or the organization's financial statements, are the primary means of conveying information about the firm. The three primary financial statements you'll hear about are the balance sheet, which is a static report of what you own and what you owe. Assets and liabilities is what comprises the balance sheet. The income statement, which is basically a flow statement, shows the flow of income through the firm, and whose basic components are revenue or sales and expenses, and then net income on the income statement. The statement of cash flows is a linkage or the nexus between the balance sheet and the income statement. The statement of cash flows answers the questions that arise from the balance sheet or the income statement. So, as I said about the balance sheet, it's a static statement. The balance sheet is basically your balance sheet or my balance sheet is basically a snapshot as of a point in time, perhaps December 31st, 2015 or 2016. It shows our net worth, our assets, what we own, minus our liabilities, what we owe, yields our net worth. Similarly, for the company, its assets minus its liabilities equal its stockholders' equity. Current assets minus liabilities will generally reflect the stockholders' equity. And just the purpose of both balance sheets are identical. The personal balance sheet is conceptually identical to the business balance sheet. The balance sheet reflects our assets owned in order of their liquidity. And the balance sheet shows things historically from an accounting perspective at cost or book value, rather than what they're worth at market value. There's some good videos in the lecture materials. One video I recommend is called the 4 Core Financial Statements. Another concept, I began talking about this just a few minutes ago. Cash flow. I don't know how to drive this home. Cash flow is the source of all employment. Cash flow is the source of all economic oxygen. Cash flow is the basic backbone of all value. Cash flow. Without it, we don't have jobs. Without it, the economy stops. Without it, everything grinds to a halt. And while I say that with emphasis, it's important to understand that profits and cash flows are not the same thing. The income statement is prepared on the accrual basis where revenues are recorded when they're earned, regardless of whether or not they've been received. And expenses are recorded when occurred, regardless of when they've been paid. What I'm saying is that cash is the lifeblood of the business. So it's important to understand the sources and uses of cash. You know, in my role as a certified financial planner, when I work with my business clients or my individual clients, I learned a lot about the people and their companies and their stage in their life cycle by examining their cash flows. How will they save? How will they invest? As an example. Let's see, there's another good video in the lecture notes called Statement of Cash Flows. I recommend taking a closer look at that. In terms of analyzing financial statements, this lecture can go on for hours. But I think that one of the key strategic takeaways from this course must be that you come away with a modicum of financial statement literacy that as a graduate student, perhaps seeking employment in the corporate world, that you can look at an annual report or a balance sheet or an income statement and discern some interesting information about the company, their trends, their profitability, their challenges, their issues. The information from the financial statements that could equip you for the most important job interview of your life. So that when you come to the time in the interview, when you're sitting for an interview for a career opportunity, an opportunity that you want, and the firm and the interviewer finishes drilling you with the questions, and they get to the end of the interview, and they say, "Okay, Mr. Interviewer, do you have any questions for us?" You take out your pad, and you proceed to ask key insight-building questions derived from the firm's financial statements that serve to not only differentiate you, but totally blow them away. Here in front of them, they have a critical thinker, a financial statement literate individual that takes the time to prepare for a very important job interview by learning about the company. I think that any one of us that would be doing the interviewing and would come across such a well-equipped, well-researched job applicant would certainly make a difference. I know it has in my experience. So I'm suggesting that financial statement literacy can serve to differentiate you and create a competitive advantage in the not so easy labor market, as a matter of fact. From the information presented on the balance sheet and the income statement, financial ratios can be calculated. There are 5 basic financial diagnostics to look at: firm's liquidity, use of leverage or debt, asset utilization or management quality, market ratios, and certainly net income ratios. Categories of ratios, categories of financial diagnostics, not necessarily the ratios themselves. Financial ratios allow for meaningful comparisons of a firm's data across time and against other firms. Having financial statements stated in relative terms, simple terms, helps people identify some of the financial strengths and weaknesses of a company, much as I would when we look at a balance sheet. When you look at a balance sheet, the first thing you might ask yourself, is it a positive net worth or negative net worth? Then maybe you look at trend over time and how it's improved. So I hope this brief discussion really presented some interesting information on the evaluating financial performance, looking at Module 2. Thank you.